Oh, hi there. Welcome to today's practical planning tip by ParkBridge Wealth Management. My name is Jonathan Shenkman. I'm the president and chief investment officer of the firm. You just caught me while I was drinking my kombucha tea. So healthy and delicious. For those who don't know, kombucha tea is a fermented drink made with tea, sugar, bacteria, and yeast. Yum. To make the drink, bacteria and yeast must first grow together to form a culture, and the culture is added to the sugar and tea, and then voila, you have kombucha. It's really one of my faves. Anyway, today we're going to continue our discussion on the basics of financial planning by using the bucket approach. We already discussed the short-term bucket, so now we're going to jump to discuss the long-term bucket. After all, in terms of importance, the long-term bucket is the next focal point. These are funds earmarked for decades in the future. They're being saved and invested to give you the option to retire at some point down the road. Most people don't want to work forever, and many people do not have the luxury of continuing to work as their health deteriorates with age. That's why saving for retirement in this long-term bucket is so important. There are many wonderful tax advantage accounts to help investors save for retirement. This includes an individual retirement account or an IRA, a 401k through a for-profit company, a 403b for a not-for-profit organization, government plans, SEPs, simple IRAs, and more. Some employers may even contribute to their employees' retirement account, which makes saving for retirement more manageable. There are rules of thumb for retirement savings. Someone starting to save in their mid-20s or 30s should allocate 10 to 15% of their income for retirement, including an employer match. If someone starts saving later in their career, this amount will necessarily need to be greater to meet retirement goals. From a tax perspective, many investors have both a traditional and Roth option. Traditional accounts invest pre-tax funds, the money grows tax deferred, and then the investor pays tax when the funds are withdrawn. In Roth funds, on the other hand, the investor contributes after-tax dollars, the money grows tax deferred, and when the money is withdrawn, there is no tax paid if all conditions are met. Determining the optimal strategy for you depends on your personal tax situation and retirement plans, so it's worth speaking to your financial advisor. However, the most important aspect of all this is making sure that you are socking away enough money towards retirement and investing it prudently. The tax benefits are secondary. And with that, I hope you found this practical planning tip helpful. Until next time, stay prudent, practical, and don't forget to plan ahead.